Hey, welcome to rainy Southern California today. And Nathaniel, you're up in Oregon.
Yes, I am.
And is it raining up there?
Absolutely not. I got the California sunshine with me.
Nathaniel's our stealth panelist, undercover SBA review contractor. I've known Nathaniel for too many years, SBA loan underwriter extraordinaire. I appreciate you joining us. Welcome all. We have some questions. I really appreciate the questions that we got this week. And if you have any additional questions, feel free to ask there. Send an email to Joseph. Joseph, do we want to try to have someone raise their hand? If you feel comfortable, you want to ask it live, raise your hand, and we'll figure out how to patch you in. Anyway, I got some poll questions. Let's go to them. A completed SBA Form 1920 will allow the underwriter to determine if the loan is eligible for SBA financing. True or false? What say you, Nathaniel?
True.
And I'm speaking to, we got one person who said false. That's true. That's true. All your eligibility questions will be answered when you complete that 1920. Second question. I put this one here. This is obviously true. It appears in the quiz after the session. I miscoded it, so I was called to task on that. I appreciate the feedback, but that is true. That doesn't mean it is. It's simply my opinion, but it is true on what I call it. Third question. A CPA may perform some analysis on a compilation financial statement. This is a preview for week 3. Give it your best shot. And we're split. We got about 70% yes, 30% no. Can you fix the feedback on me, Joseph? The answer is yes, they can. They do not have to. It's sort of a trick question. A CPA compilation statement is simply taking the borrower applicant numbers, throwing them into a spreadsheet, stamping their name on it. However, a CPA firm may choose to do some analysis. I simply bring this up is to inquire about what has the CPA done with the numbers. So that is you can answer that question both ways. And I believe I have one more question, Joseph.
Yeah.
Excess owner's draw may be added back to a loan to make it cash flow. We're going to be talking about cash flow next week. And this is just a preview. And Nathaniel, what you weigh in on that?
Yes.
Is it a best practice?
Yeah, it can be. It obviously depends on the amount of the add back and how the excess was determined.
I think how you answered it when you went, is the answer. The answer to this is yes, it can be, but I would say be careful on that and have a clear understanding of what the obligations are. Now, if you have a entrepreneur whose kid has graduated from college or the last kid has graduated from college and they're no longer making tuition payments, hey, I think that would be acceptable. But if you have someone who said, hey, I'm going to drop my salary from $100,000 a year to $35,000 a year to make this cash flow, I would be careful. We will talk about that very much next week. The first news I want to tell everybody, I've revamped the syllabus. Joseph, do we have that up? I've added 2 weeks. And I'm going to send an email out to everyone later on today explaining that. And I've consolidated some things. But I wanted to include, based upon the feedback that I had, I wanted to include 2 sessions on income statement and 1 on balance sheet. It's not SBA, but it's general financing. We just finished doing week 3. I think you will enjoy it. It was a lot of fun. Let's talk about week 2. This is what we talked about. I spent the 5 C's. Made you read that Form 1920. It's very important if you haven't do it. Again, take the time to read it. Know it like the back of your hand. It is a very important tool in terms of your SBA financing. Nathaniel, I think I learned this from you, is the underwriter is the architect. They put together the credit memorandum. They're the architect, and they turn over to the loan closer who builds the package.
Correct.
See, the pause, Nathaniel, is for you to weigh in and make me look good.
I concur.
All right, very
Do
good.
not disagree.
Okay, there you go. We like a little give and take. What do we got for the next slide, Joseph?
No question.
Oh, question? Can you bring it up? I've been tasked with an audit of the SBA portfolio. If I go through the portfolio and notice any missing documents or documents lacking SBA requirements, do we have a right to cure these loans? I just want to have a plan in place, a strategy in terms of what do I do if I have missing documentation. Nathaniel, I'll hand this off to you. What's a good best practice?
If there's missing documentation, that is critical to the SBA honoring the guarantee. Obviously, it has to be addressed. Now, as far as curing, I'm not sure if that means going back and gathering documents that were misplaced or backdating documents, which I don't think is acceptable.
Yeah, I'll give you my example. Let's say that we can't find the 1919. So what I would recommend is go meet the borrower, have them fill it out, have them sign it, but I would date it with today's date, and I would put a note in there that, hey, full disclosure, we don't know what happened to it, but we got a new one. Would that be acceptable?
Yes, it would.
Yeah, and
If you can provide full disclosure on what you
yeah, and put a note to file. And remember, we're not talking liquidation, but a great tool in liquidation is if you're missing something important, a 4506 or a 1919 that would jeopardize the guarantee. You can work with your borrower and you can have different things and say, hey, we're going to help you maybe in an offer and compromise or whatever to document the file. So the answer is yes. I would go and get them, have a plan to have the borrower sign it again, but I would not backdate anything. I'd give it the current date and say, explain why you did it. That's prudent and that's reasonable. Email question number 2. With the switch to Form 1919, it appears as though the language included on the following forms was consolidated, and now only the Form 1919 is required as replacement of the following documents: the 1624, the statements of law and executive orders, Form 652, and this was in our servicing class, and Lance responded, you are correct. The 1919 replaced all of the forms you mentioned, and also a couple more. So again, I'd like to say the SBA was the adult in the room, and they are making our lives easier as lenders. Third question. This one has to do with debt refinance, and there are new rules, and you can read through this. There's a SBA loan that was refinancing another loan. The takeaway on that is, even though SBA's made it easier for you to refinance, that's specifically in the credit card realm, you should, as a prudent lender, go back and understand what was that purpose of the original loan. I would, even though SBA says you need, if it's on the financial statement, don't worry about it. I may want to go back and do that. And remember, an SBA also gives you a number of tests, and they ask specifically when refinancing a debt, you have to do these tests. Why was the debt incurred? And this is the test. This is in the 1920. Has over-obligated or imprudent borrowing or excess owner's draw could be thrown in there, necessitated a major restructuring of the debt. And that's a test that you have in the 1920. So you are asked that. So you are required to go and understand how we got to this situation if we're refinancing from that standpoint. We can refinance an SBA loan. We cannot do it POP. Nathaniel, I didn't give this one to you, and it's sort of a difficult question. Do you have an opinion on that?
Actually, I do. I've done those deals. In fact, I've done a number of deals where, in particular, where the existing lender has an SBA loan and not willing to provide additional funding to the small business concern, submitted a GP and I've never had it decline to pay off an existing SBA loan.
Yeah, if it makes sense and we reduce the cash flow and we understand why we're doing it, absolutely. What SBA doesn't want to do, I would say there's two tests. They don't want you to loan money where the owner has looted the company, and they also don't want you to transfer risk from any institution to the government. If a refinance defaults in 18 months, you are going to have an issue with Herndon, which brings me up to my next point. That is just hot off the press. Today, Inspector General released a report on improper payments. The government considers an improper payment when they pay the guarantee and to a bank, they write a check and to honor a guarantee, and perhaps the bank did not deserve that money. Specifically, we're talking about early defaults, and I wanted to bring this up. This literally came in this morning, and the takeaway on this is they are addressing the people in Herndon with this very specific admonition, which is specifically for early defaulted loans, the assessment of creditworthiness in the checklist was limited to verifying that the lender's credit memorandum included certain elements. Now they've expanded on that. The last sentence, to address this concern, we've recommended, the Inspector General, that any checklist used by Herndon to assess improper payments includes the necessary details to ensure a thorough review of creditworthiness, including repayment ability. And repayment ability is expressly stated in here, and they will go back and tear apart your cash flow analysis on an early defaulted loan. Right, Nathaniel?
That's correct.
So when you're doing your cash flow and you want to add back that $60,000 excess owner's salary, just take a step back. My buzzword for week 3 is doesn't make sense. Doesn't make sense when a bureaucrat is reviewing this Monday morning quarterbacking and the deal has blown up from that standpoint. What else we got? Week 3. Reading assignments. If you haven't read it, please read Money Money Chapter 7. If you haven't got your book, let me know. Everyone should have it by now. I gave a couple SOP segments. I have a case study. We're introducing Sam Gray of Gray's Dry Cleaning. Nathaniel Gray's Dry Cleaning, he's 75 years old, he's selling. And we're going to do a business acquisition loan. So you're going to have fun with that. And I'm going to use that to help go through the income statement and the balance sheet. We'll have a couple more case studies. I think it will enhance the learning experience. I had fun writing it. Nathaniel, I know you haven't seen it, so I know you can't comment on it. But it'll be fun to view the income statement in that. The 5 segments are, we do an overview of financial statements, compilation, review, audited. Your world will be in the compilation and review world. We go through revenues and cost of goods sold, G&A expense, owner draw and profit, and finally the cash flow analysis, EBITDA and add backs. Do we have any questions? I appreciate, Nathaniel, I appreciate you calling in from Oregon. I appreciate the questions, and I appreciate the feedback. I've been talking to a couple of you, so please keep it. I think you're going to enjoy Gray's Dry Cleaning and what's going to happen with him. And by the way, I'm also making another amendment that you may choose this, only if you wish. Instead of having a final exam, you may choose to write a credit memorandum on one of the 3 case studies we'll have, and that will suffice in lieu of taking the exam. I would encourage you to do that. I'm not going to make a requirement of it because I didn't have that up front, but I think that would be a very nice exercise. So we're going to get 2 additional weeks. We're going to go, I think that'll put us into mid-July, but I think you'll enjoy the added bonus sessions. So with that, everyone, enjoy the weekend. Take care.
Thank you.